In this video, we're going to get into the next step of combining Apple's balance sheet with Research in Motion's balance sheet, which is to do the calculation for goodwill, and then look at some of the other balance sheet adjustments that will be necessary when we combine the balance sheets of the companies. Now, in the previous video, remember that we said that the reason we need goodwill in a transaction like this is because when we go to combine the balance sheets and we don't make any adjustments, what happens here is that the total assets is much smaller than the total liabilities and shareholders' equity by about 36 billion. And the reason for that difference is because we've paid significantly more for the company than what its shareholders' equity, its book value, would suggest. So to compensate for that, we need to, among other things, create some goodwill on the asset side in the balance sheet right here to represent that. And then we need to look at a few other adjustments and a few other new items that we're also going to need to successfully combine the company's balance sheets here. So the basic strategy here will be to figure out what the differential is. So this allocable purchase premium, we need to figure out how much greater the liabilities and shareholders' equity side is compared to the asset side. And then once we figure that out, we can figure out what percent of the purchase price we want to allocate to goodwill, for example, what part we want to allocate to intangibles, to PP&E, to deferred tax liabilities, and we can figure out what all those items should actually be. So at a basic level, remember that goodwill is normally defined to just be the equity purchase price minus the book value of the seller. So let's pull in these numbers right now. For the equity purchase price, I'm going to go up to our assumptions right here, take the 43 billion. Now for the seller book value, what we want to do here is put a negative sign in front of this and then go over to our balance sheet and take the shareholders' equity right from here. Book value, you'll see a lot of definitions for this, but for our purposes, it's referring to the shareholders' equity of a company. So assets minus liabilities, that is equal to book value in this case. Now, another thing that we typically do in merger models like this is we assume the seller's goodwill balance is written off. So it's taken down to zero. Now, this step is not completely necessary because what we could really do here is instead of worrying about this assumption, we could, on our balance sheet, we could simply replace the seller's entire goodwill right here. We could just replace that with the new number. So we don't really need to do this, but it is something that you commonly see in models. And it's just an accounting rule that's good to know that typically in an acquisition, you will write off the seller's entire existing goodwill balance. And the reason you're doing this is because oftentimes the amount of goodwill on a seller's balance sheet has drifted significantly from what its true value should be. And so when we go and create new goodwill for the combined company here, we're effectively resetting that value. We want to reset that value fully by taking off any existing goodwill and then just completely replacing it with a new value here. So that's the rationale for why we typically write down goodwill in a scenario like this. So let's link in from the seller's balance sheet. Now you'll notice here that I'm subtracting the book value from the equity purchase price, which makes intuitive sense to you. That's why we need goodwill in the first place. Why is it that I'm adding the write-off of existing goodwill here? Well, if you think about the way the balance sheet works, if we're writing down this goodwill to zero, then we're going to need to create even more goodwill right here to compensate. So if we take this to zero, we're going to need 147 more of goodwill than if we left it as is. So that's why I need to add it to this calculation for the allocable purchase premium. So let's calculate this by taking the equity purchase price, the seller's book value, and then the write-off of existing goodwill. So we have around 36 billion to allocate right here, which is actually very close to the number that we saw before. The only difference is that before we had not taken into account the write-off of existing goodwill. So we have this number, and we're getting closer to the goodwill amount that we need now, but we need to adjust a few of the other items here. So one thing that happens in an acquisition in many cases is that we adjust the value of plants, property, and equipment. And the reason for that is that similar to goodwill, oftentimes the value recorded on a company's balance sheet, especially when it's acquired, will be significantly different from its true market value. And so the 1.7 billion you see right here for PP&E for RIM, this might be completely different from its actual value in the real world. So maybe it's worth more than that. Occasionally it might be worth less than that. but you usually assume in an acquisition like this that the value is different from what's on its balance sheet. And so in an actual M&A deal, you would call in auditors and accountants and other people like that who would come in and actually value the PP&E for the seller and tell you what the new value should be. In our case, we don't have access to all that, and so we're just going to make a simple estimate here so that you can understand it and understand the basic concept behind this and how we incorporate it into our model. So we're just going to make the assumption of a 10% write-up here, which means that our market value for the PP&E and the value that is on its balance sheet, that's on our balance sheet right here, are different by around 10%, and the market value, the true market value of it, should be higher by 10%. So to actually make this calculation, we're going to take our 10% right here and then multiply by the PP&E number right here. So we see we have a write-up of 174 million. Now for the depreciation period here, remember that PP&E always carries with it depreciation. That's why it's PP&E, because it lasts over many years as opposed to just under 1 year, as with current assets, for example. So we need to assume a depreciation period on this. Now, if we were being more rigorous, we would go into their filings, or we would get information from the company themselves and figure out what the depreciation period is based on that. In our case, though, we're just going to go with another simple estimate here and say 8 for the depreciation period. The reason I'm saying this is because oftentimes PP&E like this lasts for between 5 and 10 years, so we're just picking something in the middle of the range here. So later on, we're going to have to be adding in the new depreciation that comes from writing up the PP&E by this amount, and we'll have to take that into account on the balance sheet as well. Now, if you think about the way that the balance sheet works once again, if we're adding to the PP&E number right here, we're adding to this, which means that we need less goodwill to plug the hole in this case. So anytime we have a PP&E write-up, that reduces the amount of goodwill that we're creating. And so that's why in this case, what I'm going to do is subtract the write-up of PP&E right here. And again, this is just reflecting the fact that when we write up the PP&E, we will need less goodwill because we have a higher value on the asset side. Now, if we were writing down the PP&E, the opposite would apply. So if we had a PP&E write down right here, then this would actually have a positive sign, and that would mean that we require more goodwill. But in this case, it's a write-up, so I'm going to leave it as is. Now, the other thing that often changes on the balance sheet is that the intangible asset number, the other intangible assets listed on the balance sheet right here, other intangible assets, this number often changes by quite a bit, and it's also revalued in the context of an acquisition here. The reason is very similar to why we revalue PP&E, because oftentimes the value of this will drift significantly from what's recorded on the balance sheet. And you do see that happening with other assets as well, but typically it's most pronounced with PP&E, goodwill, and other intangible assets, which is why we focus on these when we make these adjustments for our merger model here. So with fixed asset write-ups, with the PP&E write-up here, normally we assume a percentage based on the existing balance. With intangible assets, though, typically what we do is we actually look at the purchase premium right here, and we say, okay, we have 36 billion. We're going to allocate a certain percentage of this to the intangible assets. So we're essentially taking this 36 billion number and saying that part of it will go to PP&E, part of it will go to intangible assets, part of it will go to goodwill, and so on. And in the case of intangible assets, the usual assumption is that we simply take a percentage of this and say that 10% or 20% or 30%, for example, go to intangible assets. So in this case, we're going to take the 36 billion number right here. I'm going to make the assumption of 20%. This is actually a very standard assumption that you see in models. If you want to get technical, again, you should really go to accountants or auditors or anyone else who has the job of actually valuing these intangible assets. But in our case, we're just going to go with this 20% assumption. So for the actual write-up amount, we're going to take 20% and multiply it by the purchase price to allocate. It comes out to around 7 billion. Now remember that fixed assets like PP&E depreciate, intangible assets amortize. They're the same thing, except amortization is for intangible assets, depreciation is for fixed assets, tangible assets. The standard in merger models here is to assume 5 for the amortization period, and this is according to accounting standards that were put out and applies to pretty much all companies in the US. you usually assume a period of 5 for the amortization of intangible assets here, anything that's created in the context of an acquisition. So with all that in place, moving back to our goodwill calculation, remember that when we have additional intangibles, that adds to what's on our asset side, which means that we need less goodwill in this case. So what we can say here is we can take our intangible write-up amount, put a negative sign in front of it, and subtract it right there. So we have in place the write-up for the PP&E and also for the intangibles here. For the intangibles, we're just assuming that a certain percentage of the purchase price is allocated toward them. Now for the next part here, for the write-down of the deferred tax liability, this one is more difficult to explain intuitively, but one way to think about this is that when Apple goes and acquires RIM, their deferred income tax liability here is not going to be 100% applicable anymore because Apple's tax treatment may be completely different from what RIM's tax treatment is. And so usually in merger models, the assumption is that no matter what type of transaction it is, the deferred income tax liability goes away completely. So because of the different tax treatments for the companies, usually you assume that the deferred tax liability goes away completely. So for the write down here, I'm going to go and subtract the 43 million right here. Now the reason I'm subtracting this is because if we subtract this and we have 43 million less on the liability side, once again, we need less goodwill to plug the hole here. So that's how you can think about all these adjustments. Whenever we take away something from the liability side, we need less goodwill. When we add something to the liability side, we need more goodwill. On the asset side, when we take something away, we need more goodwill. When we add something, then we need less goodwill. And then the final step here is to figure in the new deferred tax liability. So the formula for this one is we take the intangible asset write-up amount plus the PP&E write-up amount, and we multiply by the buyer's tax rate, so Apple's tax rate here. The rationale for this gets very complicated and you get into very technical accounting details, but the way to think about it is going back to one of the concepts that we talked about in the accounting and three-statement model course. Every company has a set of tax books and then a set of actual books that they use in their financial statements. So they have their financial reporting and then their tax reporting. The reason we get a deferred tax liability here is because when we write up the value of intangible assets and of fixed assets, we're writing this up on our books, but for tax purposes, we're not necessarily doing the same thing. And so we get a difference here between our tax reporting and our financial reporting. And so that's why we get this deferred tax liability being created here. We multiply by the tax rate because both the PP&E here and the amortization of intangibles will be tax deductible. So we want to reflect here the fact that we're paying taxes in proportion to the amortization of intangibles and the PP&E write-up and the actual tax rate of the company. We're going to be adding in this deferred tax liability because this is something new that gets created on the liability side. Again, if something on the liability side here goes up, then that means that we need more goodwill in our calculation because we need a higher value on the asset side to balance out the liability side. So I'm going to link to the deferred tax liability right here. And now we're ready to make our calculation. So what I'm going to do is take our allocable purchase premium, subtract the write-up of PP&E, the write-up of intangibles, the write-down of the deferred tax liability, and then add the creation of the new deferred tax liability. And so we get to around 30 billion of goodwill here. And now you see why this calculation is so important, why we can't just say equity purchase price minus book value equals goodwill right here, because we have a large portion going to the write-up of intangibles, going to the deferred tax liability, and then smaller portions going to write-downs and write-ups of other items. And so that's why we need to actually do a full calculation here for goodwill rather than just saying equity purchase price minus the seller's book value. So that is an example of how we go through and calculate goodwill for an acquisition like this with Apple acquiring RIM. Again, the key point here is that you basically start with equity purchase price minus book value, but then you have to write off existing goodwill. You may adjust PP&E and other intangibles and write down the deferred tax liability. And then as a result of all these changes, you also get a new deferred tax liability getting created. The reason it gets created is because you are writing these values up for financial reporting purposes on your books, but for tax purposes, the values do not change accordingly. So you get a difference here between tax reporting and financial reporting, and that's why this deferred tax liability gets created. Once you've taken into account all those changes, then you get to the new goodwill here that gets created as a result of this acquisition. So that's how we go through the calculation and why we need to go through each of the steps here. Coming up in the next lesson, we're going to look at how we actually go about adjusting the company's balance sheets. So we're going to go back to our combined balance sheets here, and we'll see how we actually get into the business of adjusting and taking into account all these new items that we've just created.